Hello, good morning. Welcome to this edition of Canara Robeco Debt Market Outlook. I am Avnish Jain. As 2023 comes to an end, let's take a step back and look what happened in the current year. This year has been a roller coaster for all markets, especially bond markets. If we look at the US 10-year, which is a benchmark for global yields, it gyrated wildly in the year. It oscillated between a high of 5% and a low of 3.25%, essentially because market has become data driven as central banks have stopped giving forward guidance to the markets. In the last 1.5 years, especially from March 22, US Federal Reserve has raised rates by 525 basis points in 11 meetings. Last two meetings, they have refrained from raising rates, which has given some semblance of positivity to the markets. If we look at the US markets now, they are pricing in 5 rate cuts next year. This has changed drastically over a period of 1 month only. In October of 23, the markets were pricing in barely 2 rate cuts. And suddenly, over 1 month period of time, this has become 5 rate cuts or approximately 125 basis of rate cuts in 2024. This has led to a spectacular rally in bond markets as well in cross assets. We have seen US yield drop from 5% to around 4.3% in the last. We have seen US yields drop from around 5% to 4.3% in the last 1 month. Overall, the monetary policy in the US seems to be at the fag end of tightening cycle. Markets now expect that the US Federal Reserve is done with rate hikes and the next step would be a rate cut. When in 2024 it happens remains the question, because again this event will be data driven. General expectation is that the first US rate cut is likely to happen around second quarter of 2024, that is April to June period of 2024. Overall, the bond market, especially global rates, are now in a positive zone. Coming to India, Indian markets continue to do well, especially on the economic side. If you look at the macro numbers, extremely good. If you look at the growth numbers, the GDP growth which came yesterday beat all estimates, coming at 7.6% for the second quarter of FY24. Overall, for the first half of this year, GDP growth was 7.7%, beating any country in the world. Inflation has also trended down. If you look at inflation in India, it's come down from 6.5% to the last printed number of 4.9% for October. Comparably, in the US, the inflation has dropped from 6.4%, which was in January, to 3.2% in October. And that is also a reason we have seen rally in US rates as well. Considering that inflation has moderated and growth remains strong, RBI is likely to remain hold for some period of time. And we do not expect RBI to move to rate cuts. We do not expect RBI to follow the US Federal Reserve step by step, simply because India inflation is still sticky because of food prices and because the growth remains strong, which is obviously builds price pressures in the economic system. We do expect RBI to remain hold for a considerable period of time until the first US rate cut happens in the next year. Looking at markets in India in the last 1 month had been fairly flattish with the positive bias. What does the markets hold for 2024? Let's look at that. Globally, the markets in 2024 are looking good because there the inflation has dropped considerably, especially in the US, and in countries in UK and the Europe also are seeing downward trend in inflation. There is expectation of rate cuts in these 2-3 countries happening in the next 3 to 6 months. So rates there are on the downtrend, and we do expect that downtrend to continue, though it may be punctuated by wild swings depending on incoming data. However, as also indicated by commentary from US Federal Reserve members, they also believe that no more rate hikes are not required, though they differ on the start of the rate cuts next year, when they can happen. Markets do expect that rate cuts in US will start in the first half of 2024. For India, we have to look at our inflation numbers as well as growth numbers. Growth continues to remain strong, though it may moderate going forward on tighter monetary policy and base effects. Overall growth remains extremely good, and with the RBI focusing on inflation at 4%, and we are at around 5% right now, there is still a lot of space for RBI to maintain higher rates. Still, they are sure or they believe that inflation will trend towards 4% on a sustainable basis. While RBI may soften its stand on monetary policy, they may not follow the US Federal Reserve's in terms of rate cut cycle as and when it happens. Bond markets may continue to trend lower, but we do not see any major rally happening in the immediate future. Local markets will likely follow global cues in terms of volatility. One positive thing which is there in FY25 for India is the passive flows which will come from the inclusion in the JP Morgan bond index. JP Morgan index inclusion happened in September of 23, and it is likely to bring in $20 to $25 billion starting from June of 24 and stretching to March of 25. Over a 10-month period, 1 percentage point will be added from the index in terms of passive flows. So that is approximately 20-25 billion expected by markets. We expect markets to remain positive ahead of flows which will start in June of 24. Active flows may keep market in a good stead from January, February onwards, as market participants build up positions ahead of the expected passive flows, which may start from the first quarter of FY25. Overall, market are looking good, especially considering that we are now globally in a rate easing cycle starting probably in 2024. Also coupled with the passive flows which India is likely to see in FY25. Investors may build up their debt allocations from now only, because we do expect rate cycle to reverse in the first quarter of 2024. Investors may invest according to their risk profile and may choose from funds like banking and PSU debt fund and gilt fund, depending on the risk they can take. Overall, we do expect FY25 to be good for bond markets, and investors can take advantage of that by increasing allocation to debt portfolios. Thank you, and wishing everyone a very happy New Year 2024.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.